When I first started planning for early retirement, my main focus was on one big question: how much do I need to save? Then I learned how to invest that money wisely. But eventually, I realized there was a missing piece. What about taxes? It turns out that early retirement is not just about how much you save, but also how you access that money later without handing a huge chunk of it over to the IRS. So in this video, I want to share the real-life tax strategies I'm using in early retirement. Maybe you'll find something helpful for your own journey. Keep in mind, I am not a tax advisor or financial planner, just a stranger on the internet. So do your own research and contact the professionals. This is just what I'm doing. Step 1. Know where your money lives. The first step is to know exactly where your money lives. That means understanding the different types of accounts you have. Are they pre-tax accounts like a 401k or traditional IRA? Roth accounts that grow tax-free, taxable brokerage accounts, or just cash in high-yield savings? For me, I have all four. Each comes with different tax rules. Pre-tax accounts get taxed as ordinary income when you withdraw. Roth accounts allow you to pull out your contributions anytime tax and penalty-free, but earnings have restrictions. And taxable accounts trigger capital gains tax only when you sell investments. Figuring out what I had and labeling it all helped me know exactly what I was working with. Let's move on. So, step 2. Use low-income years wisely. Here's where early retirement gets interesting. When your income is low, like in those first few years of retiring early, you have a unique opportunity. For example, in 2025, I plan to live mostly off my cash and taxable savings, which means I might fall into the 0% capital gains tax bracket. That allows me to sell some investments and pay nothing for federal tax on the gains. So that's 0% capital gains tax. Estimating basis versus gains. Let's talk about how to estimate your cost basis, which is just a fancy way of saying how much of your withdrawal will actually be taxed. Option 1. Use actual brokerage reports. If you have access to your brokerage account, they often show cost basis. This is what you paid for all your investments. Unrealized gains. This is the current value minus what you paid. It might look like what you see on the screenshot for market value, cost basis, and unrealized gains. That means about 77.5% of your money is cost basis and 22.5% is gain. So if you withdraw $10,000, about $2,250 would be capital gains and added to your MAGI or modified adjusted gross income. Option 2. Estimate based on market returns. If you do not have detailed records, you can estimate based on how long you have been investing, how consistently you contributed, and your average return. For example, if you invested $300,000 5 years ago, and it grew to $400,000, your gains are $100,000, meaning 75% basis, 25% gains. Option 3. Use the general rule. If you are just doing rough planning, a conservative fire-friendly estimate is to assume 70 to 80% cost basis, 20 to 30% gains. So every $10,000 withdrawal equals $2,000 to $3,000 added to MAGI. Okay, hang in there, friends. So let's say we have this example portfolio. Assuming monthly investing from January 2020 with an 8% return, we have a total value of $400,000. With estimated cost basis of approximately $320,000, estimated gains of approximately $80,000. So a $10,000 withdrawal adds approximately $2,000 to your income for tax purposes. Okay, let's take a look at a real portfolio case study. Here is a real-world summary from my portfolio. That's a cost basis of about 90.1%, which means only approximately 9.9% is taxable gain. So, for every $10,000 I withdraw from this account, only approximately $900 adds to my MAGI. So, which investments should you sell first? This brings us to strategy. Which investments do you actually sell? It depends on your goals. Here are 3 options. Option 1. Minimize taxes. Best if you care about keeping MAGI low, like for ACA subsidies. Sell holdings with capital losses first, like VTI from the example portfolio. Then move on to those with the smallest gains per dollar, the ones with the highest cost basis. This helps you withdraw more money while keeping your taxable income low, the trade-off. It can get messy with leftover small positions. Option 2. Pro rata selling. Simple and balanced. This means you sell proportionally from all your holdings. $4,000 from this, $3,000 from that, based on your allocation. It is easy to automate and keeps your portfolio balanced, but it is not tax optimized and could trigger unnecessary gains. Option 3. Sell from overweighted holdings. If your portfolio is heavy in one area, like too much in US stocks, you can sell from there to rebalance. It is great if your goal is to hit a certain target mix. My approach based on my goals keeping Magi low, preserving ACA subsidies, and not triggering penalties, I am starting with option 1. Tax-aware selling. That means realizing losses first, then picking from the lowest gain holdings. Now moving on to step 3. Use Roth contributions flexibly. Another strategy I use is pulling from my Roth IRA contributions when I need extra cash. This is not well known, but you can withdraw your contributions from a Roth IRA at any time without taxes or penalties, even before age 59 and a half. That makes it a great emergency or flex bucket if you need a little more money in a given year without touching your traditional retirement accounts. Note: for regular retirement, i.e. not early retirement, you would want to leave those Roth contributions to grow tax-free. Step 4. Delay tapping the 401k. Speaking of traditional accounts, I currently avoid tapping my 401k or traditional IRA accounts. Instead, I plan to use something called 72T withdrawals when I reach around age 54 or 55. These allow you to withdraw funds before age 59 and a half without penalties. As long as you follow the rules, many people use Roth conversions as a way to access money early, but I prefer 72T withdrawals because they are simpler and more predictable. I like knowing exactly how much I'll get each year without the headache of conversion ladders and extra tax paperwork. Step 5. Do light planning every year. Every year in early retirement, I'll run a rough tax estimate. I look at my income, any capital gains I plan to take, and how much I might want to convert to Roth if I decide to. I don't do a full tax return analysis myself, but checking where I fall in the tax brackets helps me avoid missing sweet spots. This light annual planning keeps me on track and feeling in control. So early retirement planning is not just about saving money, it's about knowing how to spend it efficiently. Taxes are not just a yearly annoyance, they are part of your ongoing strategy. When you know how to play it right, you get to keep more of your own money working for you. If you're figuring out retirement on your own terms, this channel is for you. I'm Sparkle, and I retired early after burnout. Subscribe for more cozy, real-life financial planning without overwhelm. Remember, it is your story, you get to write it.